Okay, so here is what is happening with metals prices at the end of 2025. Well, starting in summer and fall of 2025. There is nothing extraordinary happening with metals prices aside from the price itself. In other words, there are not dramatic fundamental changes in supply and demand that is causing metals prices to run so strongly. Well, first I should point out that many, it's funny, whenever prices move, the media looks around, and not just the media, expert analysts, commentators, and the media look around for anything, any news whatsoever on the commodity, or same for the stock market. And they say, oh, well, that's the news, that's what's happening, so that must be what's driving the price, because they don't know. So recently, for different metals, and I'm referring to, let's see, tin, platinum, palladium, gold, silver, and copper. Those are the main ones moving. Tin, the least of them. So these are the different, if you Google or ask AI what's going on, it'll give different answers. Well, Google somewhere else, ask some more in AI, ask it for other explanations. It will give you more and more explanations. And they're all various, sundry explanations that, even could contradict each other. So here are some of them. Tightening supply conditions and a structural supply deficit, persistent supply deficits, broader precious metals rally driven by geographical and industrial demand factors, supply deficit plus EU auto policy changes, lifting market expectations, safe haven demand and macroeconomic and geopolitical uncertainty, industrial demand for catalytic converters, hydrogen technologies, supporting fundamentals, weak supply from key producers such as South Africa due to operational shortages, China's increased platinum imports and growing jewelry demand, market speculation and shifting warehouse inventories, tightening physical availability. Inventories is always a bogus explanation. Supply is generally inelastic in the short run, such that mining can't quickly ramp up output even as prices rise. Fundamental deficits plus tight physical supply are the backbone of the price rally. Structural mining supply challenges keep inflows subdued even amidst record prices. So those are common explanations. Much of those, as you saw, was supply and demand, or mainly supply. Okay, well, go and look at the formal supply numbers, supply and demand, but especially supply numbers for metals over the last several years, and especially this year. Nothing special is happening. Some have increased supply, some have reduced supply. When it's reduced supply, it's like 2% or something like that. So what? You have 2% reductions in supplies many years. And even with that 2%, it's probably higher than it was 2, 3, 4, or 5 years ago. So it's just nothing. It's just minor oscillations in the supply of these metals. So it's not the supply that's a factor. Things like industrial demand for catalytic converters, hydrogen technologies, et cetera, et cetera. That's an old canard. I remember in 2018, 2019, 2020, when palladium was one of the most overvalued commodities that has ever taken place at that point. And that's what they said. there's a lack of demand, electric cars are coming out, and there's all of this demand for palladium. Then, lo and behold, a couple of years later, palladium collapses. And then, oh, lo and behold, well, the demand wasn't what we thought, and there have been a lot of substitutes that could be used instead of palladium, lower grade materials, you name it. There's always an explanation. So, this kind of thing where commodity prices go ballistic or collapse, such as cocoa last 2 years ago and last year, coffee, live cattle, feeder cattle, excuse me, it's all BS. Yes, you might have some fundamental supply shortage, as you do with cocoa. But take that as an example. Cocoa had a 20-something% shortage, which should lead to a 30%, at most 40% increase in price. Well, cocoa prices were up 400%, not 40%. That's not a supply deficit. So the answer that you're looking for, what's really happening is a bunch of money is flowing into the commodity markets. You've got hedge funds and other investors, especially money coming from outside markets, such as the stock and bond markets, which are orders of magnitude larger than the very small commodity markets. They come in and they read the supply demand info, or even half of them don't even do that. A lot of them are just trend followers. They don't even know the supposed fundamentals. And they come in and look for what's moving. They see cocoa going higher. They see corn and soybeans going lower. So they jump on and follow that trend. And guess what? Jumping on exacerbates the trend. Adding money to a bet necessarily moves the price. So all these hedge funds that are coming in, buying cocoa, selling grains, that's what's causing cocoa to go so high and grains to go so low. The same thing is happening now with metals. Metals have not moved during most of this recent 5-year, or especially 2-3 year commodity rally. So now the hedge funds and other investors are going and picking up the commodities that haven't been moving much. And there is no fundamental news that should be moving the metals. Certainly not all of them together like this, or most of them. It's just for whatever reason, they started loading up on metals that pushed the price higher. Other people saw that. They came and jump on and on it goes. That is what's pushing up the price of commodities. That is usually what pushes up or down the price of commodities. The fundamentals, which aren't even correct, as commodity specialists look at them, but that's a different point. Look at my prior video on commodities. I'll put it in the link down below. I explain fundamentals and how it's so backwards. But usually when commodities move, the fundamentals are responsible for only a small portion of that move. And money flows that exacerbate that move are what is responsible for most of the rest of it. So that is what's happening with metals. Bunch of money flowing into the metals market, pushing up the price like there's no tomorrow, and it will all reverse. They will all exit their positions. It might take a while and it might be staggered. I mean, these things play out different ways. It could go straight up and come right back down. It could have a staggered fall in multiple waves over several years. But these metals prices will come down, and most of them will come back to where they started. Gold might stay higher. It usually does. It's also a money, not just a tradable commodity. And so gold might well stay higher. It tends to just edge higher over time. But a lot of what's happening with gold right now is just pure speculation also. So gold will collapse, just maybe not to the low position it had over the last couple of years before the rally. The rest of these metals will collapse, and that'll be it. And then speculators will move on to something else, maybe other commodities, maybe outside of the commodity markets. The money that flows into into commodity markets from the outside tends to come and go. It comes in waves. It last came in 2005, 6, 7, exited in 2008, kind of came back in 10, and finally left again in 13. Hasn't been back since until 2020 with the pandemic, probably with all the money printing the Fed did for the supposed pandemic. That started the rally in commodities, and the money's been there since. Twice, that hedge fund money has driven valuations to extremes. In 2022, it collapsed. They liquidated all their positions on the long and the short side, and prices came back to where they started. So this will happen again soon, and that's it. I wouldn't jump on the rally now if you haven't been on it. Um, if anything, go short, I would say, but that's not advice for investing. I'm just saying I would be more bearish than bullish at this point. So that is what's going on with metals. See you later.